Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Thursday, June 11th, 2026. We're Elena and Marcus.
Yes, welcome.
So, to start us off, imagine going to sleep bracing for a global conflict and then waking up to what is essentially the largest relief rally of the year.
Right, a complete reversal.
Yeah. Today, peace essentially broke out in the Middle East, and the market reaction across every single asset class was violent, immediate, and honestly full of underlying contradictions.
Very much so.
We have a massive amount of ground to cover in today's proprietary updates, and we want you to know exactly what to expect from this deep dive. So we're tracking 4 critical themes. Theme 1 is a massive geopolitical pivot. Basically, how a sudden halt to military strikes on Iran triggered a furious cross-asset relief rally, which completely rewrote the global interest rate narrative.
Yeah, that's the big one.
Right. And Theme 2 explores the historic $75 billion SpaceX mega IPO and how this specific offering is structurally lifting financial sector valuations across the board.
Oh, that's a deal.
It is. Theme 3 looks at a severe global rate divergence. We'll unpack why the U.S. 10-year yield plunged today while the European Central Bank hiked rates straight into a stagflationary storm.
Which is a huge disconnect.
Exactly. Finally, Theme 4 exposes the hidden fracture in credit markets. We will examine why the CCC to BB spread is flashing a major warning signal, completely contradicting the surface-level equity euphoria you are seeing on your screens today.
Yeah, the overriding catalyst driving our entire board today is really that sudden geopolitical de-escalation in the Middle East and, its immediate mechanical impact on global sovereign debt.
Right.
Because just hours after threatening targeted strikes on Iran, President Trump abruptly canceled the military action mid-session.
Right in the middle of a trading day.
Yes. He stepped to the podium and stated that a peace deal to end the 3-month war is, in his words, pretty much all wrapped up.
Pretty much all wrapped up.
And crucially for the physical markets, he signaled an immediate end to the blockade of the Strait of Hormuz.
Which is, it's the most critical maritime choke point for global energy supplies.
Indeed. The reaction across sovereign bond markets was an instant repricing of geopolitical risk.
It really was. It's striking to see the U.S. 10-year yield drop 9.1 basis points in a single session.
Down to 4.46%.
Yeah, down to 4.46, while the 2-year yield dropped 8.3 basis points. And as a quick reminder for anyone listening, that is not just an arbitrary number on a terminal screen.
Right, it affects everything.
Exactly. The 10-year yield is the gravity of the whole financial system.
Yeah.
So that drop instantly cheapens borrowing costs for regular consumers, bringing down 30-year fixed mortgage rates and auto loans.
The market essentially looked at this peace deal and just immediately stripped out any expectations for a July Federal Reserve rate hike.
Yeah, but I want to stop you there because it also mechanically pumps up the valuation of these long-duration tech stocks. So could you walk us through the actual mechanics, like just a quick, simple explanation of how this rapid drop in the U.S. 10-year yield directly impacts regular investors, specifically how it reprices the discount rate applied to their equity portfolios?
I can. So when analysts value a company, particularly growth or technology companies where, their largest profits are expected many years in the future,
right,
they have to determine what those future cash flows are worth today.
Right.
To do that, they discount those future earnings back to the present using a risk-free interest rate, which is universally anchored to the U.S. 10-year yield.
Okay, so it's the baseline.
Exactly. Think of it as an algebraic equation where the 10-year yield sits in the denominator.
I see.
So when the 10-year yield falls sharply like it did today, that denominator shrinks. The present value of the stock mechanically increases.
Even if the underlying business hasn't changed at all?
Right. Even if they haven't changed a single operation or sold a single extra product. That is why rate-sensitive equities respond so aggressively to a drop in the 10-year yield.
Yeah.
You are seeing an instantaneous repricing of future cash flows.
Okay, but stepping back, I have to push back a bit on the market's reaction here. Investors are treating inflation like a light switch that just flipped off entirely because of this peace deal.
There they are.
But when we look at our daily desk data covering the European markets, the narrative breaks down completely.
It really does.
Across the Atlantic, the European Central Bank hiked rates 25 basis points today to 2.25%. And not only that, the ECB revised their 2026 inflation forecast up to 3.0%, while simultaneously revising growth down to 0.8%.
Which is a textbook stagflationary environment.
Exactly. Plus, we had a remarkably hot U.S. producer price index print today showing 6.5% year-over-year inflation.
And the market completely ignored it.
ignored it entirely in favor of this geopolitical relief narrative. Looking at the European Central Bank's actions in that hot PPI print, inflation feels much more like a simmering pot that has just been temporarily covered by a geopolitical lid, rather than a fire that has been extinguished.
Correct. The market is selectively pricing in a disinflationary shock from the reopening of the Strait of Hormuz. Equity investors are basically assuming that a flood of delayed crude oil entering the market will permanently lower energy costs.
Right.
And that will then bleed into lower transportation and manufacturing costs, effectively extinguishing the entire inflation pipeline.
But the divergence between the US and the ECB shows how fragile that is.
Yes, the European Central Bank is explicitly telling us that the inflation shock is no longer contained to energy prices. It is widened into the core components of the economy, like services and wages.
So even if oil drops $10 a barrel,
The ECB is forced to hike rates into a slowing economy because structural inflation is already entrenched.
moving to today's data, we can trace the impact of that lower U.S. discount rate directly into the explosive moves we tracked in rate-sensitive and growth equities.
Right, the broad market surged.
It did. The S&P 500 jumped 1.75% to 7,394. But because of those discount rate mechanics you just outlined, the NASDAQ 100 heavily outperformed, closing up 3.29%.
And the Philadelphia SOX Semiconductor Index saw its largest single-day gain in months.
Exploding higher by 7.91%.
Yeah, and the specific market movers highlight the extreme concentration of this risk-on rally. Micron, trading under the ticker MU, was up 11.7% today.
Massive move.
SanDisk, ticker SNDK, was up 14.5%. And reacting directly to the prospect of lower jet fuel costs from the Strait of Hormuz reopening, United Airlines, ticker UAL, closed up 9.6%.
But examining the institutional flows in our latest run, it's vital to understand that this is not just pure fundamental buying, is it?
No, not at all.
Yeah.
Dealer desks note massive short covering in beaten-down technology names.
Right.
Investors who had bet against these stocks were forced to buy them back to cover their positions as the market ripped higher. At the same time, volatility sellers are stepping in, creating a severe squeeze dynamic that forces prices up mechanically.
Completely divorced from actual corporate earnings.
Yes.
That being said, there's a fundamental bedrock to the institutional buying, and it is heavily anchored to the consensus on artificial intelligence infrastructure capital expenditures. Our daily desk data projects, AI CapEx, will hit $920 billion by 2027, with upside scenarios reaching $1.1 to $1.4 trillion.
It's staggering.
It really is. If you step back and look at this hyperscaler AI CapEx buildout, it is very similar to historical railroad or early automotive industry buildouts.
Yeah.
Institutional investors aren't just buying individual semiconductor chips today. They are panic buying the foundational railroad tracks of the new digital economy before they get permanently priced out of the secular trend.
On that point, the median AI infrastructure stock's price-to-earnings multiple has expanded to 26 times expected earnings, which reflects that exact panic-buying behavior.
Yeah, they are paying a huge premium.
The institutional appetite for risk is voracious right now, and that specific environment set the perfect stage for the historic $75 billion SpaceX IPO.
Which priced today at $135 a share.
Yes, and will trade under the ticker SPCX. To put the sheer scale of this offering into perspective, this IPO is more than double the size of the Saudi Aramco listing, which was previously the largest in history.
Double the size.
An offering of this magnitude requires enormous institutional liquidity, and its successful pricing is structurally lifting financial sector valuations.
We saw that lift immediately in the proprietary updates. The SpaceX IPO drove the KBW Bank Index to an all-time record high today.
Right.
The lead bookrunners on the deal saw significant gains on the expectation of massive fee revenue, and really, more broadly, the reopening of primary capital markets, which have been largely frozen due to geopolitical uncertainty.
Yeah, so Goldman Sachs, ticker GS, was up 3.4%. Morgan Stanley, ticker MS, was up 2.9%. Citigroup, ticker C, closed up 3.5%.
The market is betting that if an asset of this size can be digested, the floodgates for corporate deal-making and investment banking revenues are about to burst wide open.
Moving to today's data regarding the physical inputs, we have to look at the commodities that dictate the base costs for these exact companies. The violent whipsaw in crude oil was the defining commodity story of the session.
Absolute violent.
Brent crude initially spiked above $93 a barrel when the military strike threats were active, pricing in an immediate supply disruption.
But then the peace deal was announced.
Exactly. Once it was announced, Brent completely collapsed down to $89.16 a barrel, which is a drop of 5.9%. Similarly, WTI crude dropped roughly 6% to settle at 86.52.
Which is driven entirely by expectations of the Strait of Hormuz reopening.
Right. Roughly 20% of global oil consumption passes through that specific geographic choke point, so the promise of releasing all that pent-up supply instantly crushed the geopolitical risk premium in energy markets.
But looking at today's proprietary updates, there is a glaring anomaly in the metals complex.
There is.
Because gold typically sells off heavily in a massive risk-on environment where equities surge, yields drop, and market volatility collapses. If peace is secured and inflation is dead, gold should be plummeting.
Logically, yes.
Yet gold surged 3.4% today to $4,212 an ounce, and silver outperformed with a 6.2% gain. The entire equity market is celebrating peace, so why did gold rally over 3% today alongside the tech sector?
Well, the gold rally exposes a baseline of residual uncertainty beneath the surface-level relief. Institutional investors are heavily hedging their bets because the Iranian Fars news agency explicitly denied that a peace text had been formally approved, which directly contradicts the narrative that is driving the equity rally. While gold is certainly responding favorably to the compression in real yields and the corresponding weakening of the U.S. dollar, it is primarily functioning today as a geopolitical tail hedge.
Right.
If this diplomatic deal turns out to be an illusion, the entire disinflationary narrative reverses overnight. Oil will spike back above $90, rate hike expectations will return, and equities will crater. Gold is ruthlessly pricing in that exact asymmetric risk.
Understood. Pulling these distinct threads together to synthesize the rates, equities, and commodities data, we get a highly specific picture of the current economic regime.
We do.
The cross-asset alignment you see today, with equities surging to record highs, sovereign rates dropping sharply, and oil prices plunging, suggests the broader market is aggressively pricing in a conditional soft landing.
Right. They're basically betting on perfection.
Investors are betting that central banks will manage to cool the economy without causing a recession, based almost entirely on the assumption of this geopolitical resolution holding firm.
But our credit market runs reveal a hidden fracture that aggressively contradicts that soft landing consensus. While the investment-grade corporate bond ETF, trading under the ticker LQD, rallied strongly today, it's critical to look at the mechanism behind that specific move.
Yeah.
High-quality corporate bonds rally due to duration and spread compression.
Right.
Simply put, as overall interest rates fell, the fixed payments of these safe, long-term bonds became more attractive to buyers. Simultaneously, the perceived risk of top-tier, blue-chip companies defaulting decreased in a peace deal environment, so investors demanded less of a risk premium.
The market looks at an investment-grade company and assumes it will easily survive this cycle.
Exactly.
But for those tracking our deep credit data, when you look down the credit spectrum at the weakest companies, it is a completely different story.
Very different.
We are tracking a massive divergence between CCC and BB rated bonds. The CCC to BB spread measures the extra yield investors demand to hold the absolute riskiest corporate junk bonds over slightly safer ones.
Right. And a blowout there means severe panic is brewing under the surface.
Yeah, and today, the spread between CCC and BB bonds has blown out to approximately 640 basis points. That is a 14-month wide.
It's massive.
So if the soft landing is practically guaranteed by this peace deal, as the soaring stock market implies, why are the weakest CCC borrowers acting as if we are already entering a harsh recessionary credit loss cycle?
Because for those highly leveraged companies, the fundamental damage to their balance sheets has already been done. A slight dip in the 10-year yield today does not rescue them.
It's too late.
Right. Many of these CCC-rated companies survived by loading up on extremely cheap floating-rate debt during the zero-interest rate policy era.
Yeah.
As the Federal Reserve aggressively hiked rates over the last 2 years, the interest payments on that floating-rate debt skyrocketed.
Yeah.
Even if the Federal Reserve officially pauses rate hikes tomorrow, due to this peace deal, rates remain structurally higher for much longer than these companies ever modeled for.
Right, the damage is baked in.
This sustained elevation in borrowing costs is severely compressing interest coverage ratios for leveraged borrowers that operate with razor-thin operating margins. The equity market is throwing a party to celebrate the cessation of new rate hikes. But the credit market is ruthlessly pricing in the default probability of zombie companies that simply cannot refinance their existing debt at current elevated levels.
And we see that exact same bifurcation playing out in the private credit data. Retail redemption stress is forcing funds like Monroe Capital to officially enforce a 5% redemption cap on their income fund to stop a run on their assets.
Yes.
Yet on the exact same day, institutional fundraising remains incredibly robust, with major firms like Crescent Capital successfully closing a $5.5 billion direct lending fund.
Capital is rapidly gravitating toward higher quality institutional grade lending, while retail-facing funds dealing with lower-tier credit face severe withdrawal pressures from spooked investors.
Correct. When you look closely at the flows, the market is not uniformly risk-on. It is selectively risk-on in higher quality assets and mega-cap technology monopolies, while quietly pricing in severe systemic stress in the weakest tiers of the corporate capital structure.
The bond market is signaling that the weakest links in the economy are about to snap, regardless of what happens in the Strait of Hormuz.
So, considering the VIX, which measures implied equity market volatility, collapsed 12.5% today, down to 19.44, you have to ask yourself if the market has become dangerously complacent.
Is that a question?
The entire risk-on rotation, the historic double-digit gains in the semiconductor space, and the massive collapse in consumer borrowing costs rely completely on a geopolitical resolution that has not yet been formally signed.
Right.
The credit markets are flashing red, and the gold markets are aggressively buying insurance. If a single Iranian official steps in front of a camera and denies the deal over the weekend, the entire disinflationary narrative unwinds at the opening bell on Monday.
It unravels.
Are you positioned for a scenario where this entire cross-asset rally was built on a diplomatic illusion?
To quickly summarize today's core takeaways, geopolitical relief drove a massive short-covering equity rally, structural gains for the financial sector via the SpaceX IPO, and a sharp plunge in oil and U.S. yields.
Yeah.
However, the severe blowout in CCC credit spreads, the ECB's stagflationary rate hike, and the anomaly of a surging gold price all signal lingering structural caution beneath the surface.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena Marcus. We'll be back tomorrow with the latest market color.